Saving money used to be enough to build a solid future, but that world is gone. Today, if you're just saving, you are effectively losing. The cost of waiting, potentially your financial freedom. It's time to face one truth. Investing isn't optional anymore. And yes, you might already be late. Not long ago, working hard, saving a bit, and riding out some time could get you ahead. But the structural environment has shifted. Inflation eats purchasing power, savings yields are rock bottom, pensions are shrinking, job security shifting. In this new era, your money must work, not just sit. In today's economic climate, simply saving money is no longer enough to secure your financial future. With inflation steadily rising and interest rates remaining low, the value of your savings can actually decrease over time. For example, if your savings account earns 2% interest but inflation is 4%, your real return is negative, meaning your purchasing power shrinks each year. Historically, investments such as stocks and diversified portfolios have outperformed basic savings, often yielding positive returns that outpace inflation. The power of compounding means that starting to invest early can dramatically grow your wealth over time. As financial responsibility shifts increasingly to individuals, it's important to overcome common fears about investing, such as market volatility or lack of expertise. Begin by setting clear goals, educating yourself, and starting with small manageable investments. Remember, waiting only increases the risk of falling behind financially. Taking action now is essential for building a secure and prosperous future. Let's do the math. Suppose you put $10,000 into a savings account that yields 1% a year. Meanwhile, inflation runs at 3%. Your real return is 2%. Over 10 years, your purchasing power shrinks. For example, in the UK it's reported, if inflation is 3.8% and savings interest only 2%, real returns are negative, meaning you will lose value. HSBC UK +1. So, saving alone doesn't just leave you flat. It can actually cost you. Now contrast that with investing. Looking at the broad US market. Over the past 10, 20, 30 years, the average annual return of the S&P 500 has been around 8 to 10%. Carey Punson 1, for example, one source shows, past 30 years, 1994-2024, 9.3%, past 40 years, 9.8%. Carry what that means. Suppose you invested $10,000 and left it alone. Compounding works in your favor. Yes, markets fluctuate. Yes, risk exists, but time plus discipline historically beat hoarding cash. Why is this more urgent now than ever? Because 1. Low yields, plus inflation, shock eroding savings. 2. Pensions are shrinking, defined benefit plans are rare. You're more responsible for your future. 3. Time matters. The longer you wait to invest, the less compounding you benefit from. Let's illustrate. Imagine two people. Person A starts investing $5,000 every year from age 25 until 65, 40 years. Person B waits until age 40 and invests $10,000 every year until 65, 25 years. Even though person B invests more per year, person A ends up far ahead thanks to earlier start and compounding time. That's why I say you might already be late. Time wasted can't be recovered. Another change, the financial world has shifted the burden onto you. Employer-guaranteed pensions, steady jobs for 30-plus years. These are less common. Retirement and wealth building now rely more on you. That means investing isn't optional. It's essential. If you treat investing like optional, you're ignoring the reality of your era. Now, you might have objections. Let's tackle the big three. Objection 1. Markets are too risky. True, but risk is mostly about time horizon. Over decades, history shows risk of losing money shrinks. Objection 2. I don't have enough money to invest. You can start small. Even $100 a month, compounded, makes a difference. The key is consistency. Objection 3. I'll wait for the perfect moment. Trying to time markets often costs more than it gains. Time in market beats timing the market. All of these are ways to avoid starting, but avoidance is the risk. So, how do you start? Here's your roadmap. 1. Build a small emergency fund. 1 to 3 months expenses. You need a safety net before you go full throttle. 2. Eliminate high-interest debt, credit cards, etc. Investing while paying 20% interest is backwards. 3. Open an investment account, brokerage or retirement, with low fees. 4. Choose a diversified portfolio, broad market index funds or ETFs. Keep it simple. 5. Automate your contributions. Set it and forget it. Rebalance annually. Consistency beats perfect timing. Do this month after month, year after year. It's important to align expectations. No, you won't become a millionaire overnight. Historically, broad market returns average 10% before inflation, maybe 6-7% after inflation depending on region and timing. Carry +1. The mindset shift. Think long-term, think decades, think money working for you, instead of you working just for money. And remember, the biggest risk for many isn't market drops, it's not investing at all. Here's the hard truth. The later you start, the more you need to invest and the smaller your time horizon. That means bigger monthly investments, potentially higher risk to catch up, less margin for error. But it's not hopeless. Even if you start late, starting is better than not starting. Adjust expectations. Maybe you aim for a slower pace, a more conservative plan, but still move. Because doing nothing is still a choice, just the worst one for your future. Let's recap. Savings alone can shrink in value. Investing has historically delivered superior returns and can harness compounding. The financial and economic environment means you now carry more responsibility. Delay reduces options, increases catch-up risk. But taking even a small step today beats waiting for perfect. So here's your move. Tonight, choose one action. Automate X month. Open that account. Pick a low-cost index fund. Set it and forget it. If this video helped you wake up to the truth, hit like. Subscribe for weekly finance videos, and comment below, I will start investing on date. Make your commitment public. Your future self will thank you. Because investing isn't optional anymore, and waiting is the biggest risk of all. Thanks for watching. See you in the next video. Let's build a smarter financial future together.